Assalamu alaikum. Lecture number 24 of Advanced Cost and Management Accounting. The topic we are discussing is transfer pricing. Transfer pricing policy of the company can have an impact on its profitability. Usually, transfer pricing will occur when there is more than one division, perhaps, in the company, where one component or part is being produced and manufactured in one division, and it is sold to another division, where in the second division it is incorporated into another product which we will call the final product, and it is then sold to the external market. So the price at which division 1 is going to sell the part to division 2, the price of the intermediate product, is the transfer price. Division 2, for that it will be revenue. They are going to regard that division 2 is going to regard the transfer price as cost, and that will be included in the overall cost of producing the final product and selling to the market. For division 1, it is going to be the revenue. It will have its own costs that it will incur, and the pricing, the transfer pricing, will be something which is a revenue for that division. We have discussed that there are several purposes for such a pricing, and this pricing can serve different purposes. One of them includes the management performance measurement of a division. The performance of a division will be looked at by looking at the profitability. Profitability, of course, will depend on the revenue. So the transfer pricing policy adopted will have impact on the revenue of the division. So when looking at the performance of the division and the profitability of the division, the transfer pricing will have a significant impact. Similarly, transfer pricing can also be looked at for the purpose of providing autonomy, and there are various other purposes. It will have an impact not only on the profitability of the division, but the policy adopted will have an impact on the overall profitability of the company. And we will see in some examples how setting a transfer price will impact both the division's profitability as well as the overall company profitability. Of course, the objective will be that the overall company's profitability should be maximized, should be optimized. So we will try to make recommendations of policy of transfer pricing that is best suited for overall company optimum profitability. We have discussed several methods of arriving at a transfer price. One was the market price, the other one was a marginal cost, the other one was a cost plus basis, full cost plus some kind of a margin. So all those we have discussed, and then we will see by use of an example how selecting the appropriate one is going to impact the company's profits. Let's start with an example. The third division and the Makran division are divisions within the Balochistan group. One of the products manufactured by the third division is an intermediate product for which there is no external market. This intermediate product is transferred to the Makran division, where it is converted into a final product for sale in the external market. 1 unit of intermediate product is used in the production of the final product. So in this example of the Balochistan group, there are two divisions. One division is called the third division, the other division is called the Makran division. The intermediate product is being produced in the third division, and it is being sold to the Makran division. And Makran division is then completing the product, making the final product and selling to the external market. We are told that 1 unit from the third division is used in the final product produced by the Makran division. The expected units of final product which the Makran division estimates it can sell at various prices is as follows. These are now the range of selling prices, and we have shown in front of them what is the quantity expected to be sold at that price. So for example, at 100 selling price, the expected quantity is 1000. When the price is reduced to 90, the expected quantity for sale is 2000. Then as price is reduced to 80, the expected sale will be 3000 units, and so on until at 50 selling price, the quantity sold would be 6000. We are all aware that as prices are reduced, the quantity expected to be sold is increased. So now this is relevant to transfer pricing because it will be important that the transfer price that is used will have impact on the quantities sold. So the selling price is going to be affected by transfer price. As the transfer price is set, the quantity is going to be affected. Here we saw in our example that when we have the selling price at 100, we expect to sell 1000 units. But then when the selling price is reduced to 90, we expect to sell 2000 units, and so on. So the selling price is being affected by the transfer price. The selling price of the final product is going to be affected by the cost, overall cost, and part of the overall cost will be the transfer price used to purchase the product, intermediate product. The cost of each division are as follows. For third and for the Makran division, variable cost per unit is 11 for third division and 7 for the Makran division. This is the variable cost per unit of the division itself. So when the intermediate product is produced, the cost of third is 11 rupees per unit, and then when it is transferred. So when a unit is produced in third division, the variable cost is 11 rupees per unit, and as it is transferred to the Makran unit and the Makran division, there the cost is going to be 7 per unit in addition to the transfer cost. The fixed total costs for each division have been shown as 60,000 and 90,000. The transfer price of the intermediate product has been set at rupees 35 based on full cost plus markup. Looking at the cost, we are first of all looking at variable cost. Each division will have its own variable cost, it will have its own fixed cost, and therefore a total production cost. In our example, we are told that the variable cost for the third division is 11 rupees per unit. This means when the intermediate product is produced, it is costing 11 rupees per unit without including the fixed cost. The fixed cost for the third division, we are told, is 60,000. So that will comprise the total cost of this division. The 11 rupees per unit of variable cost and the 60,000 as a period full fixed cost. When the intermediate product is produced and it is transferred to the Makran division, the cost within the Makran division, the variable cost is rupees 7 per unit. This is the cost of the Makran division itself. This at the moment, of course, does not include the transfer cost, the price of the intermediate product which has been purchased by the Makran division. And then the fixed cost of the Makran division itself is rupees 90,000. 90,000 is incurred by Makran division itself as fixed cost, and the variable cost is rupees 7 per unit. With this cost, the transfer price that has been set by the company is rupees 35 per unit. 35 per unit on full cost basis, on a full cost plus markup basis. So just thinking of what full cost was, there is within the full cost, the component of the variable cost, then a component of the fixed cost, and sometimes a markup is added as a profit margin. Therefore, the supplying or the manufacturing division will have some profit margin of its own. When we look at the fixed cost of the third division, we find fixed costs are 60,000. In order to arrive at a per unit component of the fixed cost, an estimate will have to be made of the total number of units that are likely to be produced, so that you can arrive at a per unit fixed cost. Some kind of rate is going to be established, and a fixed overhead cost rate will be used to load the fixed cost onto the per unit cost. A profit margin is therefore added. So the margin, profit margin plus the fixed cost in the case of the third division is rupees 35 minus 11, which is 24. So 11 becomes the fixed cost, the variable cost, and 24 is the total of the fixed cost plus the margin. Transfer price has been set on full cost basis, full cost plus markup basis, and that amounts to rupees 35 per unit. This 35 per unit will be carried to the Makran division, where it will incorporate in its own cost this total cost of 35 and arrive at the full cost for the final product. At the transfer price of rupees 35, profit computation for each division will be, this is the working which shows the computation when the transfer price is rupees 35 and the product is transferred from the Thar to the Makran division. If the output is 1,000 units, the revenue at 35 is going to be 35,000. The variable cost, we know from the previous slide, of 11 rupees per unit, the variable cost total will be 11,000. And the fixed costs are given as 60,000. So the total cost, yani fixed cost plus variable cost, will amount to 71,000. And the revenue is 35,000. This will give a profit margin of 36,000. This is at the output level of 1,000. When the output is increased to 2,000, the revenue will increase from 35,000 to 70,000. The variable cost of 2,000 units at 11 rupees per unit will be 22,000. Fixed costs remain the same, and the profit now will become the total cost of 60 plus 22, which is 82,000, less the revenue of 70,000, giving a loss of 12,000. So this chart is showing the total amount of profit or loss at the various output levels. Once we know what is the variable cost per unit, so that at 1,000, when the variable cost is 11 per unit, the variable total cost will be 11,000. The fixed costs are, we know, as 60,000, and the transfer price, which is going to determine the profit, that price has been set at rupees 35 per unit. So for 1,000 units, the revenue to division Thar, which is producing the intermediate product, the revenue is 35,000 at the production level of 1,000 units. 35,000 is the revenue, whereas the total cost is the 60,000 fixed cost plus the 11,000 variable cost, which is 71,000. So at 1,000 unit production, the overall performance of division Thar will be a loss of 36,000. We saw that this loss is reduced to 12,000 when we move from 1,000 units to 2,000 units. Here, the revenue will increase at the rate of 35 per unit from 35,000 to 70,000. Fixed cost per unit remains the same, which is 11. So at 2,000, this becomes 22,000. And of course, the fixed cost will remain at 60,000 as they are. So fixed cost 60,000, variable cost 22,000. This becomes 82,000. And when the revenue at 35 rupees is 70,000, this gives a loss of 12,000. So as the unit go up from 1,000 to 2,000, the loss has been reduced from 36,000 loss to 12,000. Then when the units are increased to 3,000, remembering 35 to be our revenue of transfer price, the total revenue becomes 105,000. Variable cost at 3,000 will be 33,000 and fixed costs remain 60,000. So the total cost is fixed cost of 60,000 plus 33 variable cost 93,000 and the revenue is 105,000. So this is going to give us a profit of 12,000. So once 3,000 units of output has been reached, the division's performance will convert from loss into profit and will show a profit of 12,000. And so on, moving on to 4,000 units, where revenue becomes 140,000 and variable costs become 44,000, fixed costs remaining at 60,000, the profit moves to 36,000. At 5,000 units, the revenue becomes 175,000. Variable cost is 55,000. Fixed costs remain at 60,000. And this 60,000 plus the variable cost 55,000, 115,000. And deducting that from the revenue of 175,000, the profit is 60,000. So the profit is going to be 60,000 at the output level of 5,000. Moving on to 6,000, the profit will have gone up to 84,000. Where fixed costs will remain fixed, the total revenue will increase as the outputs increases. And we saw that after 2,000 units, our losses turned into profits. And from there on, because we are assuming constant variable cost and constant revenue, as we increase the number of units, the total revenue increases and the profitability continues to rise. And at 5,000, it is 60,000. And at 6,000 units, it increases to 84,000. The Makran division is the receiving division. In the receiving division, the intermediate product is received at rupees 35 per unit. And this is therefore the cost to this division. When its output is 1,000 units, the revenue at 100 is going to be 100,000. Variable cost, we were told, are 7,000 of the division itself, which is at the rate of 7 per unit from the earlier slide. And the transfer cost is 35,000. Fixed costs, we were told, are 90,000. So here, the total costs are 90,000 fixed costs, transfer cost of 35,000, other variable cost of 7,000. This is when deducted from the revenue of 100,000 is going to give a loss of 32,000. For the Makran division, which is now the buying division or the receiving division, the transfer price is going to have the effect of cost. So its profitability is going to be affected as the transfer price is increased or decreased. Here, the transfer price has been set at rupees 35 per unit. So 35 per unit is the rate at which costs will be included in the accounts of Makran division. At the output level of 1,000, 35,000 cost was included as a transfer in cost. Its own variable cost, we were told, is 7 per unit. So that is 7,000. That makes 42,000. And the fixed costs were 90,000. So a total of 132,000 is the cost at output level of 1,000. We were also told that the price is 100 when the output is 1,000. So at the price of 100, the revenue is 100,000, and that gives a loss to the division of 32,000. When output moves to 2,000, the revenue increases to 180,000. Now the revenue per unit is rupees 90. So at 2,000, the total revenue is 180,000. Variable cost was 7 per unit. this is 14,000, and the transfer in cost for 2,000 at 35 rupees is 70,000. Fixed costs remain fixed. This is 90,000. So the total of 90 plus 70 plus 14. This is 186,000, and deducted from the 180,000 revenue, this is going to give a profit of 6,000. The 14,000 and the 70 and the 90 put together give the total cost of 176,000, and deducted that from the 180,000 revenue, the profit is 6,000. At the level of 4,000 output, the revenue increases to 280,000. Variable cost goes to 28,000, and transfer in cost is 140,000. Fixed costs remain 90,000, so the profit is 22,000. So we can see that at 1,000 there was a loss of 32,000. At 2,000 the loss turned into a small profit of 6,000. At 3,000 the profit is 24,000. At 4,000 the profit is 22,000. 5,000 the profit is 0, and at 6,000 again there is a loss of 42,000. This slide is showing us the pattern of costs and revenues and profits as the sale to the external market increases. We were shown a slide where as the quantity is increased, the price would have to be reduced to the selling price to the external customer. Of course, when we were looking at the sale from the third division to the Makran division, over there we set the price, transfer price as 35 rupees. So that remained constant at whatever level of output. So as we saw, as the quantity was increased, so did the revenue and so did the profit. But here, where in the Makran division, the sales are being made to the external parties, being made to the external market, here for the quantity to increase, there is a reduction in price. So as we saw at 1,000, that was showing a loss. But as the quantity was increased, it increased the profits to a point. But after a point, because the price has gone down, and the price is now below, so where fixed costs can no longer be recovered, there at that higher output, the company will start to incur losses again. So there will be an optimum level of output where the company is going to maximize its profits. So from the perspective of the company, it will want to arrive and be operating as an output which maximizes its profits. Seeing that 35 was the transfer price, that is taken in as a cost. This is how it is going to impact the profitability. So now Makran division is going to see where is its profit being maximized. And we saw in the slide that the profit was maximum at the output of 3,000. At 3,000 units, the profit was maximum. After that, the profits began to decline, and at 6,000, they were showing a loss. The supply division maximizes profits at an output level of 6,000. The supply division is the third division. That is the one that is supplying the intermediate product. That is going to maximize its profits at the level of 6,000 units, where the receiving division maximizes profits at an output level of 3,000, as we just saw in the last slide. Because in the receiving division, the selling price is going to be reduced as sales units are going to be increased. Receiving division will therefore purchase 3,000 units from the supplying division. This is because Makran will expand output as long as net marginal revenue exceeds the transfer price. The net marginal revenue is equal to the marginal revenue from sale less the marginal cost of conversion excluding the transfer price. So we can see there is a difference, and this is the impact of the transfer price. At the price of 35, the supplying division would like to supply 6,000 units. But the buying division or the receiving division, which is in this case third division, they maximize their profits at 3,000 units. So they will opt to purchase 3,000 units and no more in order to maximize their profits. Again, we are looking at the impact of the transfer prices. As long as the net marginal revenue, we are told, of the receiving division is going to exceed this transfer price, it's going to continue to buy. The net marginal revenue we have described as the revenue from the transfer pricing, the revenue from sale of the product minus the variable cost excluding the transfer price. So as long as its own operating cost without the transfer price is going to exceed the transfer price, hence the revenue is going to be in excess of costs, this division is going to continue to buy. But once that happens, and when the marginal revenue falls below the transfer price, in this case the transfer price is 35. So when the per unit marginal revenue falls below 35, the buying division, receiving division is going to stop buying. And therefore, for the company, they will need to decide at what transfer price is the overall profit of the company being optimized. We are now going to look at a working of the net marginal revenue. We have said that the net marginal revenue is the selling price minus the variable cost excluding the transfer cost. So at 1,000 units, our revenue, the price was 100, the revenue is 100,000. The variable cost of the Makaran division is rupees 7 per unit. So the variable total cost would be 7,000, and hence at 1,000, the marginal revenue would be 93,000. At 2,000 units, the marginal revenue is going to be the 100,000 will be 93. Now the additional 1,000 is going to be the 180 minus the 100,000, which is 80,000 minus the 7,000. So for the next 1,000 units, the marginal revenue will be 73,000. And then when the output goes to 3,000, the next 1,000 units, the marginal revenue will be 60,000 minus 7, because now the price has gone down. And the total revenue is 240,000. So 180 we have taken in the first two rows, and now at 3,000, the next 1,000 is going to be 6,000 minus 7,000, 60,000 minus 7,000, which is 53,000. And so on. At the 4,000 level, it's the next 1,000. Here, the net revenue, marginal revenue is 33,000. This 33,000 is below the 35,000 cost of transfer price, and therefore the buying division will stop at 3,000. The marginal revenue, the calculation shown in this slide, is for every additional 1,000 units. So at 1,000, it was 93,000. At 2,000, 1,000 will be at 93, and the second 1,000 is going to be the incremental, which we calculated at 73,000. Now, as long as this net additional revenue from the additional 1,000 units continues to be in excess of 35,000, the division would continue to buy and it would make profits. When we have set the transfer price at 35,000 for 1,000 units, so the marginal revenue, the moment it falls below 35,000, it will no longer be a decision for this division to continue to buy. Here, at 4,000, the net marginal revenue of the last 1,000 units is 33,000. So the managers will not opt to buy this production after 3,000 because the cost would be 35,000 and the additional revenue would be 33,000. So they would stop at 30, they would stop at the output level of 3,000. This is showing you the impact of this transfer price on the overall decision making and profitability of the company. As we move along then, anything in excess of 3,000 is going to provide a net marginal revenue below that of the transfer price, and the divisions will opt not to buy that. Faced with a transfer price of 35,000 per 1,000 units, the Makran division will not expand output beyond 3,000 units because the transfer price for each batch will exceed the net marginal revenue. As we have said, that the Makran division will continue to buy products and buy output from the third division as long as its net marginal revenue, the additional revenue for every additional 1,000 units, continues to be in excess of the cost. The cost for this unit, and for this division is 35,000 for each 1,000 units. And this we have seen that at the level of 33,000, which is the cost when the output is 3,000, and the output is 4,000, then the company is going to cease its purchasing at the level of 3,000. Profits at different output levels for the company as a whole. Note, these calculations do not incorporate transfer price as they are intercompany items and will cancel out. Now we are going to see what would be most suitable, most profitable for the company as a whole. We saw in the first case, the third division, where it could sell 6,000 and it would maximize its profits at that level. Then we saw the Makran division, that for the Makran division, it was most suitable to buy up to 3,000 and no more. But now let us look at the company as a whole. When we look at the company as a whole, we are not going to include the transfer price, because the transfer price, being an intercompany item, it's revenue for one division and cost for the other division, and on the company-wide basis, it is going to net off and be eliminated. So let's look at what would be the performance when we look at the company as a whole. At 1,000 units, the revenue at 100 will be 100,000. The variable cost of both the divisions is 11 plus 7, this is 18, and so it's 18,000 at the level of 1,000 units. Fixed cost of the two divisions combined is 90 plus 60, this is 150,000. So at 1,000 units, the loss the company would make is 68,000. As this production and output increases to 2,000, here the price will go down to rupees 90, so revenue is going to be 180,000. Variable cost will remain 18, and the total variable cost will be 36,000. Fixed costs will remain fixed at 150. Here the loss is going to be 6,000. Output increased to 3,000. Revenue is now 240,000. The price is 80, and the variable cost is 54,000 from the per unit cost of 18 rupees per unit. Fixed costs remain at 150, and now at 3,000, the profit is going to be 6,000. So at 3,000, 240 is the revenue, 54 is the variable cost, 150 is the fixed cost, and the profit is 36,000. We have moved from losses to profits at 3,000. Increasing that to 4,000, the revenue goes to 280,000. Variable cost is 72,000. Fixed cost is 150,000. And the profit increases to 58,000. Moving on to the level of 5,000 units, the revenue is 300,000. Variable cost is 90,000 plus the fixed cost of 150,000. Now the profit is 60,000. But when we move from 5,000 to 6,000, the revenue is again 300,000. The variable cost is 108,000. Fixed costs remain at 150,000. And the profits at this level are 42,000, which is less than the profit at 5,000 of 60,000. This slide is showing us the picture of the company as a whole. Here, the transfer cost has not been included because, as we said, transfer cost on a company-wide basis is revenue for one division and cost for the other, and it cancels out. So we have looked at the revenue of the final product, and that revenue, let's say at 1,000, was 100,000. The variable cost is going to be the cost of the two divisions combined. 11 was the cost of division Thar, and 7 was the cost of the Makran division. That gave a total variable cost of 18 per unit. So 1,000 units, the variable cost was 18,000. Also, the fixed costs for the company as a whole, we are going to combine the fixed cost of both the divisions. One division had a fixed cost of 60,000, the other had a fixed cost of 90,000. So we have taken the total fixed cost as 150,000. So at that revenue of 100,000, we are given fixed cost of 150,000 plus variable cost of 18,000. This shows the company at this level would make a loss of 68,000. Now, as we project further the revenues as output is increased from 1,000 to 2,000, 2,000 to 3,000, and so on up to 4,000, 5,000, and 6,000, the chart is showing us that the maximum profits the company would make would be at the output of 5,000. And at 5,000, the total profit would be 60,000. This is the maximum profit for the company, as at the output level of 6,000, the profit is reduced to 42,000. So 5,000 from the company perspective would be the optimum. Let's remember that the maximum output shown for division A, which was division Thar, that was being shown as 6,000, the profit maximizing output. And when we looked at division Makran, using the 35 rupees transfer pricing, the Makran division was showing a maximum profit maximizing output of 3,000. So neither are actually showing what is most optimal for the company as a whole. This is the impact of transfer pricing, and therefore it's important to examine the effect of transfer pricing. The company would like to maximize its overall profits. This is done at the output level of 5,000. And if the managers were deciding independently in the Thar and the Makran division, they would not reach this decision of 5,000, which is overall optimum for the company. This, therefore, is the impact on company's profitability that the transfer pricing policy is going to have. The profit maximizing output for the company as a whole is 5,000 units. Therefore, the current transfer pricing does not motivate divisional managers to operate at the optimum level for the company as a whole. This example, therefore, has shown us that transfer pricing is going to affect decision making, and it is going to affect decision making in different ways and will impact the overall company profitability. If the division managers are going to only look at division profits, then the decisions made with regard to output and level of sales might be suboptimal for the company as a whole. To induce overall company optimality, the transfer price must be set at the marginal cost of the supplying division, which is the unit variable cost of rupees 11 per unit. Therefore, transfer price for a batch of 1,000 units should be 11,000. Now, the receiving division will expand output as long as net marginal revenue exceeds transfer price. Net marginal revenue at 5,000 units is 13,000. The transfer price is rupees 11,000. Therefore, expanding output to this level will increase profits. So, the recommended price, transfer price, would be the marginal cost of the supplying division. The marginal cost is the variable cost without including the fixed costs. So the variable cost is rupees 11 per unit, in the third division. If the variable cost is set as the transfer price, the cost of 1,000 units would be 11,000. Now, therefore, the buying division, the receiving division, Makran, will continue to buy as long as the cost is, and the cost of buying in is going to be less than the net marginal revenue. We had seen that the net marginal revenue at 5,000 units was 13,000. So it would make sense for the Makran division to buy at this level of production, which is 5,000, where the net marginal revenue still exceeds the cost of the product coming in, which would be 11,000. So this would give a decision which would be in the overall company's interest. The benefit and impact of this decision would be optimal for the company as a whole. We had used 35, which we said was on the basis of cost plus, full cost plus a markup. And that price did not give the appropriate decision for the managers of the Makran division. And therefore, it also did not give the appropriate decision for the company as a whole. Setting the transfer price at the unit marginal cost of the supplying division will motivate managers to operate at the optimum output level for the company as a whole. It is not a suitable measure for divisional performance as fixed costs are not covered and loss is reported. We have said earlier that there are various purposes of setting the transfer price. And among the purposes is a measure of performance for the division. Now, just looking at this example, if we use the marginal cost of the supplying division, which was 11, and if we use that as the transfer price, we said this is optimal for the company as a whole. But when judging the performance of the division, this price of 11 per unit is not going to cover the fixed cost of that division, third division. Third division has a fixed cost of 60,000. So third division at the price of 11 rupees would be showing a loss of 60,000 in its profit and loss. So therefore, this price might be appropriate and optimal to set for the company as a whole, but it might not be appropriate to measure the performance of third division on this basis. That's where some conflicts arise, and therefore these are the things that must be kept in mind when making decisions about transfer pricing. Consider a full cost transfer price with markup. Unit fixed cost has to be estimated at the planning stage using a predetermined fixed overhead rate. At 5,000 units output level for the company, fixed costs per unit for the intermediate product will be rupees 12 per unit. 60,000 being fixed costs divided by 5,000 units, giving a full cost of rupees 23 plus the 12 plus the 11 variable cost of 23 per unit. If the transfer price is set at rupees 23 per unit, 23,000 per 1,000 batch, receiving division will expand output as long as net marginal revenue exceeds the transfer price. This will be 4,000 units where net marginal revenue is 33,000. At 5,000 units, net marginal revenue is 13,000, and manager will not choose to expand the output to 5,000. Now let's look at the case of the full cost. What happens if we use the full cost? The full cost is going to include the variable cost as well as the fixed cost. So therefore, some kind of a rate will be established at the start of the period to estimate a full cost per unit. Let us say that we assume the 60,000 full cost is going to be spread over the 5,000 units. We expect to produce 5,000 units. At that production level, the fixed cost per unit would be rupees 12. 60,000 divided by 5,000. Now, the variable cost of the third division we know is 11. The fixed cost additional would be rupees 12. So this will give a total of 23 rupees per unit for the total cost of this unit. 23 would be the full cost. And now that would be set as the transfer price. So 1,000 units would have a transfer price of 23,000. Again, looking at our chart, we'll see how far would the manager in division Makran go and how long will they continue to increase their output. At the 23,000 level of transfer pricing, the Makran division managers would go as far as 4,000 units and not up to the 5,000. Because once again, they will look at the net marginal revenue. What is the net marginal revenue? And whereas net marginal revenue, as long as that is in excess of the transfer cost, the division is going to continue to buy. This will happen at 4,000. At 5,000, the net marginal revenue will be less than the transfer price. So again, using the full cost is going to give us a suboptimal result. Really, we have got the optimal result by using the variable and marginal cost and not the full cost. So this has shown you how transfer price is going to impact profitability of the company as a whole and of the divisions. And we have seen that as a recommendation, the most optimal price is the variable cost or the marginal cost of the supplying division. But this price, we have also seen that will not serve the purpose of performance measurement of that division, because at this price, fixed cost of that division will not be recovered and that division will show a reported loss. That's all for this session. Thank you very much.